You've spent decades making every dollar count, maxing out retirement contributions, building a cash cushion for emergencies, and choosing safe investments that promise peace of mind. It feels like you're doing everything right. Your portfolio ticks upward, your checking account balance never dips below a comfortable floor, and you can point to line items showing how each move protects your future. But here's the uncomfortable truth. Some of the smartest sounding retirement habits can become hidden time bombs, quietly eating away at your savings until you wake up one day with far less than you expected and no easy way back. In this video, we're exposing 7 of those well-intentioned practices that over the next 10 years can leave you scrambling for extra income or even forced to downsize your lifestyle. We'll dive into why hoarding cash reserves feels prudent until inflation and taxes turn those dollars into dust, and how locking into lengthy annuities can trap you in deals where fees drown your gains. You'll see why an all-bond portfolio can rob you of growth just when you need it most, and how relying exclusively on tax-deferred accounts can push huge withdrawals and big tax bills right into your golden years. We'll reveal the unexpected downsides of over-insuring with expensive policies, the dangers of maintaining a pre-retirement spending pace on a fixed paycheck, and the risk of letting your investments sit untouched for years without a strategic tune-up. Each habit we uncover isn't born of neglect or greed. It springs from a desire to feel secure. But security without balance can be its own form of risk. Stay tuned, because understanding these pitfalls now gives you the power to adjust course, blend safety with growth, and ensure that the retirement you've planned for doesn't slip through your fingers a decade from now. Holding half your portfolio in cash feels like the ultimate safety net. You never have to worry about market swings, and you can sleep soundly knowing your principal is untouched. But here's the catch. Cash rarely keeps pace with inflation, and it's fully exposed to taxes. While a 2 or 3% return might look better than a down market, prices for groceries, utilities, and healthcare often rise at 4 or 5% each year. Over a decade, that gap can slice your purchasing power in half, turning what you thought was a fortress into quicksand. Every dollar you hold in savings loses real value, even if the nominal balance stays the same or grows just enough to feel comfortable. And because that interest is taxed at your ordinary rate, you're actually earning less than the sticker APY suggests. What's worse, when you rely too heavily on cash, you forfeit the growth opportunities that come from a balanced mix of bonds, equities, or inflation-protected securities. Without those engines, you have no buffer against rising costs or unexpected bills. As your expenses creep upward and your income stays flat, you'll eventually be forced to dip into principal. Exactly the scenario you were trying to avoid. That erosion can accelerate quickly if you begin tapping into your savings to cover standard withdrawals or surprise costs. Moving the date, you might need help from your children years closer than you anticipated. Holding cash sounds foolproof, but overloading on liquidity without a plan for growth and tax efficiency can hollow out your nest egg over time. And the reality is that this risk lurks behind every no-risk advertisement for savings accounts and money markets. But cash isn't the only safety-first strategy that carries hidden dangers. Locking into a long-term annuity can feel like planting a flag in guaranteed income for life, but many retirees don't see the fine print until it's too late. You're sold on the idea of a steady monthly check no matter how markets behave. Yet you may not realize that those promises come with high embedded fees, restrictive surrender charges, and growth rates often below inflation. Annuity providers build in layers of costs, mortality and expense fees, administrative fees, rider fees for inflation protection or death benefits that quietly eat away at the principal before you even see your first payment. Then there's the surrender schedule. If you need access to a lump sum for unexpected medical bills or to help family, you could face penalties of 7, 8, sometimes 10% in the early years. That means dipping into your guaranteed plan feels more like breaking a piggy bank with scissors. And while annuities shield you from market dips, they also prevent you from benefiting when stocks or bonds rally. Your payout rate is locked in at the start, so any upside is permanently surrendered. Over a decade, A conservative 4% annuity yield can look pitiful next to even a balanced portfolio's 6 or 7% average, especially once you factor in inflation. What feels like a fortress under threat-free skies can turn into a trap when you realize your heirs receive little or nothing if you pass away early, and any death benefit rider you added likely came at a steep monthly cost. By the time you understand that your annuity's growth is lagging, your expenses have outpaced your payments, or surrender charges still apply, you've often vanished your ability to pivot, leaving you stranded with a plan you can't escape and income you can't boost. That rigidity can force retirees to postpone essential expenses, tighten budgets drastically, or rely on their children for financial relief, all because the smart move to lock in income turned out to be one of the riskiest decisions you can make without fully mapping out the trade-offs. Shunning equities entirely may feel like the ultimate act of prudence, zero stock market drama, no heart-stopping downturns to worry about. But by cutting out equities altogether, you trade away your most powerful tool for growth and inflation protection, leaving only fixed income assets that often can't keep up. Imagine relying 100% on bonds, CDs, or savings yields that average 3 to 4%, while the consumer price index steadily climbs at 2 to 3% or more. On paper, those returns seem safe. They're relatively stable and predictable, but over a 10 to 15-year retirement horizon, they simply don't generate enough growth to make up for rising costs or to recoup the damage of early withdrawals. Worse, you expose yourself to sequence of returns risk in reverse. Without any equity cushion, a downturn in the bond market or an unexpected spike in interest rates can wipe out paper gains and force you to sell holdings at depressed values to cover living expenses. Even low volatility bond funds are not immune to interest rate shocks, and cash yields, as we've seen, often lag far behind inflation. By avoiding stocks altogether, you lock in a no-growth portfolio that slowly erodes in real terms. Your principal may stay nominally intact, but its spending power shrinks year after year. And because your income is tied to payouts from these fixed assets, you'll eventually find those distributions can't keep pace with everyday expenses, let alone surprise medical bills or long-term care costs. Without the long-term upside that equities historically provide, you'll be forced to dip into your principal continuously, accelerating the day when your nest egg can't support you, pushing you into dependence on your children or other sources of help. So, while the idea of zero risk may seem appealing, excluding growth assets from your retirement, mix can be one of the most dangerous safety strategies you adopt. Relying exclusively on tax-deferred accounts like traditional IRAs and 401k, might feel like the smartest play. You postpone taxes now and let your investments grow unmolested, but that strategy can blow up later, especially once required minimum distributions kick in. Every dollar you tucked away grows tax-free today, but comes withdrawal time, it's treated as ordinary income, and the IRS demands its cut. If you've stacked most of your retirement savings in these accounts, you'll likely face massive forced withdrawals in your 70s and 80s, pushing you into higher tax brackets and triggering surcharges on Medicare premiums. That bracket creep doesn't just mean bigger tax bills. It also eats into your ability to manage your income because you lose flexibility. You can't choose when or how much to take beyond what the IRS mandates. Mix that with the fact that tax laws and brackets can change over time, and you're sitting on a ticking time bomb. Without a balance of Roth or tax-free buckets, you have no shield when income thresholds shift, and you could end up paying 20, 30, even 40% in taxes on your own saved money. Worse yet, those high taxable withdrawals can make more of your Social Security benefits taxable and raise Medicare costs through IRA, creating a cascade of penalties you never planned for. Savvy retirees hedge this risk by carving out a portion of their savings into Roth IRAs or even municipal bond funds, accounts that offer tax-free or tax-advantaged distributions, giving them the power to manage taxable income in retirement. But skipping that step and relying solely on deferred plans turns what seems like a smart deferral into a future liability, gradually hollowing out the net value of your nest egg and forcing you to tap into principal or lean on family support when the tax hammer finally falls. Buying excessive insurance coverage might feel like the ultimate safeguard. You're protected for every medical surprise, every long-term care scenario, but those high-premium policies can stealthily drain your retirement resources long before you ever file a claim. Take Medigap Plan G, for example. It covers almost every out-of-pocket cost that Medicare doesn't, from your part a deductible to skilled nursing facility coinsurance, but at the cost of monthly premiums that, for a couple, can easily exceed $600 to $800 combined. Over a decade, you could pay close to $100,000 in premiums alone, funds that never return to you unless you die and have a beneficiary clause attached, which often comes with its own restrictions. And then there are hybrid long-term care annuity policies that bundle care coverage with investment components. On paper, they sound ingenious. You earn a modest return on your premium dollars, and if you need care, you get daily benefit payouts. But dig into the fine print, and you'll find layers of surrender charges, inflation riders priced at double-digit rates, and strict underwriting requirements that often deny coverage to those who most need it. By the time you trigger benefits, you may have paid more in premiums than the policy ever pays out. Even standalone long-term care insurance, once touted as the gold standard, has become prohibitively expensive for new buyers, with premiums rising 5 to 10% annually and policies laden with inflation protection riders that significantly increase costs. Many retirees discover too late that they're locked into plans they can't afford, yet can't escape without losing years of premium payments. That money, hundreds of dollars each month, could have been invested in growth assets, used to build a dedicated care fund, or simply kept as flexible cash for unexpected expenses. Instead, it's gone, paid to insurers for a safety net that may never materialize or may only benefit heirs in convoluted ways. In the end, over-insuring becomes a hidden tax on your own security, shaving off precious nest egg years before you ever see a dime in claims, and pushing the day you might need to lean on your children closer than you ever imagined. You may think that sticking to your pre-retirement lifestyle, dining out twice a week, taking those annual vacations, splurging on hobbies, will feel like freedom once the 9 to 5 stops, but living like you did when you were earning a steady paycheck can quickly push you off course when income switches to fixed withdrawals and interest checks. Small indulgences you once chalked up as just part of life suddenly become regular budget line items that compound over months and years. A $50 dinner out tonight is still a $50 dinner out every few weeks, and that weekend getaway you used to book on a whim now requires tapping into your nest egg. Over a decade, these recurring expenses add up in ways many retirees underestimate, shifting the date when you'll exhaust your principal years sooner than expected. What makes it worse is that retirees don't always feel the pinch immediately. There's still money in the account, and monthly statements look fine. So the habit continues unchecked until you realize your cushion has shrunk to a fraction of what you thought. At that point, slashing those little luxuries feels like an impossible sacrifice, and you may find yourself reluctantly dipping into your children's support network to cover everyday costs you never planned to offload. The truth is, your spending habits need an overhaul once a pay stub disappears. What felt sustainable on a rising salary doesn't translate to a declining balance. Rather than mirroring your former lifestyle, a more balanced approach involves scaling discretionary costs to a sustainable level, reimagining vacations, reallocating entertainment budgets, and prioritizing value over frequency. By adjusting your mindset now and setting realistic goal-based spending limits, you protect your independence and keep your savings on track, rather than slipping into a cycle where keeping up becomes the very thing that forces you to lean on your kids. Years into retirement, it can be tempting to pat yourself on the back and think, I set this up years ago, why tinker with it now? But ignoring regular portfolio checkups is one of the riskiest habits you can adopt, because the financial world never stands still. Market conditions shift, interest rates fluctuate, tax laws evolve, and your personal needs change as you age. Without scheduled reviews, ideally at least once a year, you risk staying overweight in assets that no longer serve your goals, missing opportunities to lock in gains or harvest losses, and failing to adapt your withdrawal strategy to current conditions. Imagine you built a conservative mix 5 years ago. 40% stocks, 50% bonds, 10% cash. Over that time, rising equity markets push your stock allocation to 55%, while bond yields tumble and cash yields crater. Suddenly, instead of the balanced risk you planned, your portfolio carries much more market risk, and when a downturn hits, you're exposed more than you realized. Conversely, a portfolio tilted too heavily toward bonds can leave you vulnerable to inflation or rate shocks without the growth cushion to rebound. Beyond asset allocation, tax efficiency strategies change. New opportunities arise, like converting to a Roth IRA at lower tax brackets or rebalancing to capture tax loss harvesting benefits. And Medicare income thresholds, RMD tables, and inheritance laws can shift, altering the optimal sequence and amount of withdrawals. By skipping these check-ins, you let outdated assumptions govern your finances. Worse, failing to adjust spending plans for changes in life expectancy, health costs, or family needs can turn your nest egg into a static target for erosion. A periodic portfolio audit isn't about constant trading or chasing the latest hot fund. It's about ensuring your plan remains aligned with reality. By proactively reassessing and rebalancing, you can smooth out risks, seize new opportunities, and protect against silent drifts that inch you closer to dependency on others. In other words, making time for regular reviews is a small effort today that can pay dividends in security and independence for years to come. Retirement should feel like the reward for decades of hard work, a time to savor freedom rather than fear the next market swoon or tax bill. But as you've seen, some of the moves that feel safest today can quietly sabotage your security down the road. Holding massive cash reserves may shield you from volatility, yet inflation and taxes stealthily whittle away at your buying power. Locking into a long-term annuity can promise lifetime income, only to trap you in high fees and low growth while surrender charges punish any sudden need for extra cash. Ditching equities entirely may spare you stress in a down-earn, but it also robs you of the growth engine needed to keep pace with rising costs. Relying solely on tax-deferred accounts defers taxes now, yet forces big withdrawals later that can catapult you into unpleasant higher brackets and trigger surcharges on Medicare and Social Security. Over-insuring with expensive policies might sound prudent, but sky-high premiums often outweigh the benefits and drain your portfolio before you ever file a claim. Maintaining pre-retirement spending habits feels comfortable until fixed withdrawals can't match those recurring expenses, pushing you toward tapping your children for help. And setting your plan on autopilot without periodic checkups lets silent shifts in markets, tax laws, and your own needs steer your finances into dangerous waters. None of this happens because you were reckless. You simply followed common wisdom that without context and balance becomes a liability. The key takeaway? Security in retirement isn't about eliminating every risk. It's about blending safety with growth, tax efficiency, and adaptability. By recognizing these 7 hidden pitfalls now, you can recalibrate your strategy. Diversify between cash, bonds, stocks, and tax buckets, review your policies for value, adjust spending to sustainable levels, and schedule annual portfolio audits. That way, you're not just guarding what you've saved, you're ensuring it lasts as long as you do on your own terms so you never have to lean on your children before you're ready.